I expect silver to outperform gold going forward. Use silver as collateral for loans. The registered inventories on Comex are coming down quite sharply. There's almost no silver left in Shanghai. I agree with Michael Oliver. So when you look back, the correction we saw.
Everyone is wondering, why is the price of gold plunged about 20% from its record high around the start of the war?
It's provided liquidity. Case in point, Turkey, they've had to swap or sell their gold and then have a contract to buy it back in the future because they needed the funds. And it's very easy. It's the most liquid asset. The main reason why I think gold is better than sovereign debt is because the gold is neutral and there's no counterparty risk. Gold doesn't default. Gold just sits there and you can't conjure it up out of thin air. I think cash is still not a bad thing to have because we still can't pay for things with gold. It's very volatile. It's not for the faint-hearted.
Since the start of the war, silver has been much harder hit than gold, as it's viewed not only as a monetary metal, but an industrial metal. Are you seeing changes around the globe in how investors view silver, and what role are you expecting for silver to play moving forward for the investing class?
Yeah, we're definitely seeing silver change from not just like industrial metal, even though that's still very important, but we're seeing countries now also starting to buy silver as an alternative to treasuries, as like a safe haven. India is very much into that. And so is China. I think in India, they're going to allow people to use silver as collateral for loans. Prior to the war, I was hearing that the Gulf cooperation countries, they were not just buying gold, but buying a lot of silver as well. And also, the supply situation has been precarious for silver for the last 6 years or so. And we're seeing, Gary, as well, I'm sure you're looking at this, that the registered inventories on Comex are coming down quite sharply, and that there's almost no silver left in Shanghai. So silver, I think it was Jim Sinclair who said that it's like gold on steroids. So it will go up very sharply, but it will also come down very sharply, and that's what we've seen this year.
Silver is being treated as a dual threat asset, both industrial and monetary, yet its supply is crumbling unnoticed. As Mario Innecco points out here, India and China are expanding silver purchases as a treasury alternative, signaling rising geopolitical hedging. Registered inventories on Comex are falling sharply, while Shanghai stocks are nearly gone, a warning that markets may underestimate scarcity. Jim Sinclair's gold on steroids comment hints at extreme volatility ahead, meaning investors holding silver must brace for rapid swings. Next, Mario Innecco discusses how these moves might reshape investor strategy in the coming months.
But I expect silver to outperform gold going forward because that's what it has done in the last 60 years or so when we've had bull markets in the precious metals.
Are you in the same camp, Mario, as Michael Oliver, founder of Momentum Structural Analysts, in that the drop silver has experienced, the volatility silver has experienced, is currently, it's similar to what was experienced in the 79-80 run-up and the 2011 run-up. At one point, he was calling it a little wiggle in the charts, but I mean, it doesn't feel like a wiggle when you're going through it. But it then took off like a rocket ship to a new pricing paradigm. Or do you have a different expectation for silver moving forward?
I agree with Michael Oliver. So, yeah. And I think when you look back, the correction we saw at the end of January, beginning of February, is going to look like a blip. Just like, the stock market in 1987 dropped 22% in a day. If you look at the long-term charts now, you can't even see it. And I think by the end of the year, the Dow was making another all-time high.
Historical parallels suggest volatility may mask long-term gains in silver. As Mario Innecco points out here, comparisons to the 1979 to 80 and 2011 run-ups show current swings are not unprecedented. What feels dramatic now could be minor in retrospect, as the Dow's recovery after the 1987 crash illustrates. Investors must weigh short-term turbulence against structural bull trends in precious metals, particularly given silver's under-allocation in portfolios. Next, Mario Innecco talks about why these patterns might signal broader shifts in market risk perception.
Everyone, out there is wondering, why is the price of gold plunged about 20% from its record high around the start of the war? Gold as a safe haven should have gone up on the worsening inflation outlook. It should have gone up on the mounting geopolitical risks. These are all usually very bullish developments for gold and should remain so. What's your read on why gold has fallen like it has?
Yeah, I mean, the first day of trading after the war started, gold and silver did go up, and then it's been going down. And yes, treasuries have been going down too, so they haven't acted as a safe haven. But the question is on gold. I agree. I had a look at what gold and silver did in 1973, because back then in October, the oil producing countries, OPEC, and under the leadership of the Saudis, they imposed the oil embargo, and oil went through the roof. It used to trade around $3, and it went up to 12 in the next 6 months. And it took gold and silver dropped for the first few weeks or first month of that crisis, and eventually it took off. So I'm not saying it's exactly the same thing that happened in 1973, 74, but it's similar. And we forget as well that during times of crises like we're having now, gold has actually, I would argue, acted. It's done what it says on the tin.
Despite a 20% drop, gold isn't failing. It's fulfilling a nuanced liquidity role unseen in headlines. As Mario Innecco points out here, historical crises like the 1973 OPEC oil embargo show initial dips often precede sharp recoveries. Treasuries also failed as a safe haven, emphasizing gold's unique structural position. Investors focusing on daily price movements risk missing the bigger picture of capital flows and macro instability. Next, Mario Innecco unravels why these patterns might signal resilience rather than weakness in gold.
It provided liquidity. Case in point, Turkey. They've had to swap or sell their gold and then have a contract to buy it back in the future because they needed the funds. And it's very easy. It's the most liquid asset, and it has been for thousands of years. So I would argue is some of that. And I would argue as well that there's a lot of uncertainty. We don't know in the next hour what's going to happen. We keep getting conflicting comments from the Trump administration, from Iran, from everyone. So as we speak today, though, I noticed that gold and silver are doing very well, while the stock market is down about 1%. So is this the end of the period of seemingly gold having lost its safe haven status? It could be. And I'm still of the belief that it will act as a safe haven. I just think there's still a lot of uncertainty relative to what energy prices are going to do. I mean, we're still told that if the war ends, oil price will go right back down and everything will be okay. But I think there's a lot more to it, because a lot of the production capacity in the Middle East, there's a lot of backlogs as well worldwide for everything. And I think, if the war were to end tomorrow, I think it could still impact the economy for at least another year. And I don't think the war is going to end tomorrow. I think it could drag on for a long time.
Liquidity needs, not panic, often drive gold movements during crises. As Mario Innecco points out here, Turkey's gold swaps demonstrate how nations leverage gold to fund short-term obligations without undermining long-term value. Conflicting geopolitical signals and uncertain energy markets keep gold's trajectory volatile, yet it continues to outperform stocks in sudden downturns. Investors ignoring structural factors risk misreading temporary dips as a loss of safe haven credibility. Next, Mario Innecco shows why patience in gold allocation is critical amid ongoing geopolitical friction.
All right, so in times of war and crisis, investors have historically flocked to treasuries. Many guests have come on here recently to Metals and Miners, and they've stated that they believe that the U.S. is headed for a sovereign debt crisis. With gold dropping and treasury yields rising, what's your case for gold being better than sovereign credit, and why investors shouldn't allow the beating war drums and the falling gold prices to lead them to panic sell their gold?
Well, the main reason why I think gold is better than sovereign debt is because the gold is neutral and there's no counterparty risk. You hold a gold coin or a gold bar, that's no one owes you anything. You've got the money. You have a treasury note or a treasury bond or bill. If you want cash, you need to go and sell it. And maybe the broker that holds your treasury might not, like MF Global years ago, they went bust, and it took months for you to get your securities back. Or I'm not saying the United States is going to default, because they can always print. So, and I think that's what's going to happen. I don't. Alan Greenspan said some years ago that we can always print, he said, and Austin Goolsbee was next to him, and he went like this.
He said, the U.S. will never default. We could always print.
Yeah. So that's the default, and that's why. And gold doesn't default. Gold just sits there, and you can't conjure it up out of thin air.
Rising treasury yields and falling gold often make headlines, but the true story is about counterparty risk and liquidity. As Mario Innecco points out here, holding physical gold is inherently neutral. There's no reliance on a broker or government promise, unlike sovereign debt. Past failures like MF Global highlight vulnerabilities in financial intermediaries that are invisible in daily coverage. Investors tempted to panic sell gold due to temporary headline fear may be ignoring structural safety. Next, Mario Innecco shows why physical gold remains a bedrock in portfolios even during volatile fiscal cycles.
You gotta mine it. It's not easy mining. First, you have to do some exploration, and then there's all kinds of risks as well involved.
So if the economies of the world move towards this type of crisis as a result of this war and the overarching debt and the macro setup that pre-existed the war, presumably gold would skyrocket as capital flows leave the stock and bond markets, and they also leave cash, and they flee to sound money, right? Is that your base case, that you're expecting that capital is going to flee the stock and bond markets and cash and rush towards sound money, gold?
Well, I think cash is still not a bad thing to have, because we still can't pay for things with gold, unfortunately. Turkey just proved that. But I think in terms of asset allocation, yes, I don't think we'll see a massive rush. But the point is that so little is invested in gold. I think it's about 1% at the most of all investable assets are in gold. And we still have this 60-40 portfolio of stocks and bonds. So even if you were to get 5% of all the capital that is parked in treasuries and other government bonds flowing over to gold, that would be massive.
Only 1% of investable assets are currently in gold, yet even a modest shift could reshape markets. As Mario Innecco points out here, physical mining constraints and geopolitical risks mean gold supply cannot quickly expand to meet sudden demand. Even a 5% migration from treasuries could spark outsized price moves, highlighting structural underinvestment in sound money. Investors need to balance liquidity in cash against long-term security in gold, especially as macro debt pressures mount. Next, Mario Innecco discusses why this tiny allocation gap could trigger major portfolio rebalancing.
That's like 5 times more than there is in gold. And then if you add the general stock market as well, let's say another 10%, the sky is kind of the limit. But I'm not saying people are going to rush, completely all into gold. I don't, that would only happen maybe if people lost complete faith and confidence in the monetary and governmental authorities. That would be more like Weimar Germany, which is possible, but
maybe not probable.
Not probable, yeah.
Gold versus stocks, the 1-to-1 ratio that we saw, years ago, and that could be coming back. The gold mining stocks, their free cash flow should explode in this base case scenario as capital flows increase towards gold. And inflation is increasing, et cetera. Do you believe investors are going to view this as begin to see them as safer investments, even over traditional equities, maybe even over bonds, and begin migrating over to these gold miners that are showing escalating, increasing, expanding free cash flow margins?
Yeah, and silver as well, I would say. And even before this very painful correction we've seen in the miners of late, they were already undervalued.
The headline risks of gold versus equities obscure the real story of capital flows. As Mario Innecco points out here, even modest reallocation to gold miners could unleash dramatic growth in free cash flow. Yet this remains underappreciated by the market. Comparisons to Weimar-style collapses highlight extreme scenarios, but the more likely outcome is gradual rebalancing toward undervalued precious metals. Silver follows a similar undervaluation pattern, creating multi-asset opportunities. Next, Mario Innecco shows how these shifts may redefine relative safety in investor portfolios.
So they're even more undervalued now. As for whether investors are going to rush into it and see it as a safe haven, it's possible. I definitely see it as a good place to be. But I would add that you need to manage your risk there because it's very volatile. It's not for the faint-hearted.
It's definitely not. All right. So
market perception often mislabels undervaluation as immediate opportunity, masking the risk volatility introduces. As Mario Innecco points out here, gold and silver remain attractive, but only for investors prepared to manage swings carefully. Headlines suggesting a rush to safe haven overlook the nuance. Even solid assets can experience sharp intraday or geopolitical shocks. Proper risk management remains critical, particularly for new entrants chasing gains without appreciating liquidity constraints.